September 16th, 1992. Inside Admiralty House in London, British Prime Minister John Major and his cabinet are huddled around a transistor radio, listening as their national currency goes into freefall. Just a few blocks away, the Bank of England is hemorrhaging money, desperately buying up British pounds to stop a total collapse, but they are losing. Across the Atlantic, a single hedge fund operating out of New York has placed a staggering $10 billion bet against the British pound. By the end of the day, the UK Treasury will be forced into an unprecedented surrender, abandoning its currency peg and reorganizing European monetary history. It is a day that will become known as Black Wednesday, the day a private investor took on a central bank and won. But the story of how the Quantum Fund broke the Bank of England isn't just a tale of financial piracy. It is a story of a fatal mathematical contradiction, a political trap, and the brutal reality of macroeconomic gravity. To understand how a sovereign nation could be cornered by a hedge fund, we have to rewind to October 1990. The United Kingdom had just entered the European Exchange Rate Mechanism, or ERM. The ERM was designed to stabilize exchange rates across Europe. Britain agreed to peg the pound to the German mark at a central rate of £1 to 2.95 marks, with a strict 6% permitted fluctuation band. It was a political commitment to stability. But underneath that commitment, a massive economic fault line was forming. In 1992, the German economy was absorbing the massive shock of reunification. To combat post-reunification inflation, the Deutsche Bundesbank aggressively held its interest rates high. But Britain was in a very different position. The UK was trapped in a deep, painful recession. To stimulate its domestic economy, Britain desperately needed lower interest rates. But because the pound was pegged to the mark, lowering rates would cause the pound's value to drop below its permitted ERM floor. The UK was legally bound to import Germany's high interest rates, suffocating its own economy just to keep a political promise.
This growing macroeconomic mismatch did not go unnoticed. Inside the Quantum Fund offices at 888 7th Avenue in New York, Chief Strategist Stanley Druckenmiller saw a structural flaw that was mathematically unsustainable. The British government was trying to defy economic gravity, maintaining artificially high rates in a recession. Druckenmiller brought the trade to George Soros, the founder of Quantum Fund. Their conclusion was simple. Eventually, the political pain of the recession would become too great. The UK would be forced to cut rates, and the pound would plummet. Between August and early September of 1992, the Quantum Fund began quietly building a massive short position against the British pound sterling. They were borrowing pounds, selling them for marks, and waiting for the inevitable devaluation. It was a high-stakes game of chicken with the Bank of England, but Soros and Druckenmiller were convinced the central bank was defending an indefensible position.
The tension reached a boiling point on September 15th, 1992. Helmut Schlesinger, the president of the Deutsche Bundesbank, gave an interview to journalists in which he hinted that a broader realignment of European currencies was necessary. History is conflicted on this exact moment. UK officials would later blame Schlesinger for intentionally sparking the run on their currency, while Schlesinger maintained his remarks were simply off-the-record general economic commentary. Regardless of his intent, the global currency markets smelled blood. For George Soros, Schlesinger's comments were the catalyst. He authorized Quantum Fund to aggressively expand its short position to a staggering $10 billion. The hedge fund was now directly challenging the financial firepower of the United Kingdom. As the sun rose in London the next morning, the floodgates opened.
The morning of September 16th was pure chaos. As the markets opened, a massive wave of selling hit the sterling. At the Treasury Building in Whitehall, Chancellor of the Exchequer Norman Lamont directed a frantic crisis response. The Bank of England was spending billions, buying pounds by the second to prop up the price. Behind the scenes, the desperation was even deeper. Documents released under the Freedom of Information Act in 2005 revealed that the UK Treasury used $12.5 billion in forward swaps to hide the rapid depletion of their reserves through a secret negative forward book. But the market kept selling. At 10:30 in the morning, the Treasury announced an emergency interest rate hike, raising base rates from 10% to 12%. It did nothing to stop the bleeding. In a final, desperate move at 2:15 in the afternoon, they announced a second rate hike, pushing interest rates to an agonizing 15%. It was an impossible rate for a country in a recession, a glaring signal that the central bank was out of ammunition.
The market called their bluff. Traders knew the British government could not survive the political fallout of a 15% interest rate. By that evening, the defense had totally collapsed. Chancellor Norman Lamont appeared on television to announce that the UK was suspending its membership in the ERM, and he cancelled the 15% rate hike. The pound immediately crashed. The Quantum Fund made a historic fortune, though exact figures remain disputed. Profit reports vary between $1 billion on the pound short specifically, up to $2 billion across all European currency positions during the crisis. For the British taxpayer, the cost was devastating. Initial government reports claimed reserve losses around $2 billion, but the later Freedom of Information releases showed nearly $40 billion in intervention spending, with a finalized net loss to the Treasury calculated between £3.3 billion and £3.4 billion. In the aftermath, George Soros was immortalized as the man who broke the Bank of England. But while the Quantum Fund executed the fatal blow, they were merely the catalyst. Broader market forces and a fundamental structural macroeconomic mismatch ultimately drove the forced devaluation. A central bank cannot perpetually defend a currency peg that contradicts its own domestic economic reality. Today, the legacy of Black Wednesday is deeply polarized. Was it a catastrophic political and financial defeat that humiliated a nation on the global stage? Or was it, as some argue, an economic liberation that finally freed Britain from crippling interest rates and paved the way for subsequent economic growth? It all depends on your economic perspective. But the undeniable truth of September 1992 is this: when political ambition collides with fundamental market reality, the market eventually wins, no matter the cost.